Hi everybody, this is Also Hub. I'm Giacomo, and today I'm going to analyze Adobe. This is one of the stocks that you asked me to analyze. So before we get into the content of today, I want to make sure to say this is not financial advice. Do your own research if you want to invest in a stock. And yeah, that's basically it. And the data that I've used for this analysis, I've taken it from the New York University website, the part managed by Aswath Damodaran, that is widely regarded as one of the best experts in valuation and corporate finance. And I've taken the rest of the data from Seeking Alpha. You can get a discount on the subscription of Seeking Alpha by using the link that you will find in the description of the video. So you can get a bit of a discount for a really, really good service. You can find articles, analysis, financials, and so on and so forth. You can create your own portfolio over there. So yeah, let's get into the content of today. So Adobe, over here I've made an estimate of the cost of capital, the weighted average cost of capital. I've started by going through the cost of equity. I've taken the interest rate swap for the next 10 years as a reference. That is around 4% as of now, and the risk premium, I've used the spreadsheet that Aswath Damodaran publishes every year, and the risk premium for the US was 4.6%. So I've used it, and I've taken the beta for the last two years as a reference for Adobe, and it was 1.92. I usually do the opposite. I use commas instead of points and points instead of commas, because in my language we usually do it this way. So I'll just tell you so that you don't get confused. So the cost of equity comes out to be around 12-13%. It's a bit high, but we'll stick to that for now. Then the cost of debt, I've taken also the interest rate swap and then added a spread, because you're still investing, in this case, in a bond of a private company. So it is riskier than the US bond for the 10 years. So you have to account for the risk that you're taking on. So here's the debt to capital and the equity to capital ratios. So yeah, Adobe doesn't have that much debt. So and that's why I've calculated the WACC this way. It is high for now, but I've accounted for the WACC to go down quite a lot, because in good times, as rates go down, it would naturally go down, but also in this case the company would probably rely more on debt rather than equity, and therefore it could decrease even faster the cost of capital. So here's some financial highlights for the last 10 years: revenue, earnings, free cash flow. We can start off with the revenue. It has grown on average year on year. I've done the calculation through the compounded annual growth rate. It is almost 19%, so a pretty important number. The earnings even more. Not only Adobe has increased its earnings, but it probably has increased its margins as well. And then we have the free cash flow, that is, it has grown by using the compounded annual growth rate. It has grown 21.49%. So now we start making assumptions for the future. So that means that we're going to make assumptions on how the free cash flow can grow over time. And these are my assumptions. Here's the growth that I expect from now to the end of the year. And then I have the short term for the next 2 years, medium term for the remaining years, and then I've used the long term for the terminal value calculation. I've taken as a reference what it has done in the last 10 years, and then it decreases over time because you have to take into account that it's very hard for companies to have such strong growth in the long run. And given that these are just assumptions, you need to be conservative. I've already tried to account for the exceptionality of Adobe given the moat that it has, especially in the graphic design part of the business. That is the one that I know best because I've used Photoshop, Illustrator, InDesign, Premiere, and so on. And Adobe on that side doesn't really have rivals, so it has a really good strength on that side. So I've taken the long-term growth and I've put it a little bit more than what I would do with a company that doesn't have such a strong moat. So I've accounted it to grow slightly more than what is regarded as the long-term growth projections for the United States. That is around 3.1, around that area. So I've taken it a little bit higher than that, just a little bit. And so here's the calculation for the terminal value and the present value of the terminal value. I've added this to the value of the free cash flows at the present value. And then here's some other things that we need to take into consideration in order to make a valuation. So this is the net debt. Actually, it's a net positive position because Adobe has more cash than what it actually has in debt. So this is actually a positive figure. It doesn't have options outstanding as I've when I looked at the last 10K, but it has restricted stock units and performance stock units, that is employee stock based compensation to reward employees with that. So it has, as of the last 10K, it had 8.3 million shares dedicated to the employee compensation. So you have to account for that and value that, give an estimate to that value in order to account for possible dilution in the existing equity. So here's the number that I come up with as the value of equity, and I divide it by the outstanding shares. So here's the value that I come up with that is slightly higher than the current share price as of Friday 12th of July. I'm recording this on Sunday 14th. So my valuation with these assumptions is around 14% higher than the current share price. But you have to take into consideration that these are just assumptions, as I said. So you need to be conservative. If you want to be more conservative, we can decrease that to 3, for example. We can decrease this to 18, and we can see how it affects our valuation. So it has a pretty big change. So that means that when you make these sort of valuations, you need to have a margin of safety. So given the results that I have, I think that Adobe is fairly priced. It's not underpriced. So it would make it a really good buy probably if for some reason in the short run it would go down a bit. But yeah, Adobe is a really great business. It has a really strong moat. So I wouldn't bet against Adobe anyway, even if I thought the stock was overpriced, because it has a really good moat, as I said. And yeah, we can change a lot of the assumptions that we make, and we can see how it affects um, the valuation. And by, for example, changing the weighted average cost of capital, we can see that, for example, if we change it to a little bit higher, maybe it has some effects, and yeah, decreases a bit the valuation. But yeah, you have to stay conservative when you make these kind of valuations. So this is it for today. Thanks for watching. Make sure to like, subscribe, and comment if you want me to use different assumptions, if you want another company, if you want me to analyze another company that you like. Make sure to comment it in the description, and I'll take note. And yeah, thanks for watching. This is it for today. I'm Giacomo. This is Hustle Hub. See you next time.